According to Statistica, there are currently over 10,000 different cryptocurrencies in the world as of this February 2022, and that can make it hard to choose where to invest and if whether what you are investing in is a good idea, and that is where tokenomics come into play. Before we go on to look at what tokenomics is, we first need to understand what a crypto token is. Summed up, it is essentially a token and often refers to any cryptocurrencies besides Bitcoin and Ethereum, even though they are also technically tokens. But because Bitcoin and Ethereum are by far the biggest two cryptocurrencies, it's useful to have a word to describe the universe of other coins, such as altcoins. So now, what's tokenomics? The term tokenomics is formed by combining the words token and economics. So the term tokenomics basically is the study of the economics of a crypto token. It refers to all the crypto token's features that make it desirable to investors. The tokenomics for a specific cryptocurrency is usually clearly detailed in the project's white paper, and it should help you understand the crypto token's objectives, functionality, allocation policy, and more. Simply put, it fundamentally involves studying the factors that impact the demand and supply of tokens. Because the law of supply and demand is immutable, tokenomics has a significant impact on the value of every cryptocurrency, NFT, and DAO, and every other type of token-based project. Projects can use blockchain technology to create microeconomies. They need to decipher how tokens should work within their ecosystem to become self-sustaining. When it comes to tokens, there's no such thing as a one-size-fits-all attitude. Blockchain has opened the door to a wide range of applications and implementations, and tokenomics allows teams to design a new model or adapt an existing one that fits with what the project aims to achieve. If done well, this can create a stable and high-functioning platform. Tokenomics essentially takes what central banks use as a monetary policy and apply it to blockchain networks. In order to learn about tokenomics, it is essential for you to first understand the different types of tokens. Tokens can be classified according to the structure of tokens and also on the basis of usage. The structure of tokens can be classified into, firstly, layer 1 tokens. These types of tokens are native to a particular blockchain and are used to power all of the services in the blockchain. Layer 1 solutions change the rules of the protocol directly to increase transaction capacity and speed, while accommodating more users and data. The BNB on Binance Chain is an example of a layer 1 token in cryptocurrencies. Then there are layer 2 tokens. Layer 2 tokens refer to a network or technology that operates on top of an underlying blockchain protocol to improve its scalability and efficiency. This category of scaling solutions entails shifting a portion of a blockchain protocol's transactional burden to an adjacent system architecture, which then handles the brunt of the network's processing, and only subsequently reports back to the main blockchain to finalize its results, an example being Ethereum's Plasma. On the basis of usage, tokens can be categorized into, firstly, security tokens. Security tokens are called investment contracts, and they must meet several conditions for the same. These tokens are subject to securities and regulations. In simple terms, security tokens on blockchains will get their value from tradable and external sources. For this reason, they will always be subject to government regulations, making them a safer choice. And next, utility tokens. Utility tokens are another significant type of token that you will come across in tokenomics. These types of tokens are issued through an initial coin offering, or ICO, and they are useful for financing a network. ICOs are essential for funding project development. Tokens can also be further classified into two categories: fungible tokens and non-fungible tokens. Fungible tokens are recognized for having the same value as well as replication facility. The scenario of ETH on Ethereum is a perfect example of a fungible token. ETH tokens' value is the same and they can replace each other since their value is the same. On the other hand, non-fungible tokens, or NFTs, do not share the same value, and so they are unique. NFTs have been trending in recent times, and they sparked a lot of interest in tokenomics, especially with high-profile NFT auctions. The tokenization of assets such as real estate, artwork, pictures, and collectibles with NFTs has sparked a new wave of digital ownership revolution, while also showcasing the potential of tokens. The objectives and through the design of tokenomics, it is intended to answer the following questions. Firstly, nature of the token. What is the main function of the token? The governance, security, and utility. The token type setting depends on the main goal the token has for the network. For example, a governance token is used to distribute decision-making power to its holders and make the protocol decentralized. Secondly, usability. What are the token's use cases and the reward mechanisms for the participants? Thirdly, the monetary policy. How is the token distributed over time? The choice of the initial token allocation and the release schedule to stakeholders shouldn't be underestimated, as they are very important aspects from investors' perspective. And lastly, governance. Who has the decision-making power in the network? The governance settings has to do with the protocol decentralization degree. So you may be wondering, what factors are included in crypto tokenomics? Tokenomics is an incredibly important concept for you to understand when you're trying to decide which crypto to invest in, since the factors included will definitely affect your investment. To put it simply, any factor that even remotely concerns the value of a crypto token should be taken into account when considering its tokenomics. Some of the key metrics you should check for when trying to decide a crypto token's worth are: firstly, the allocation and distribution of tokens. Check to make sure you know how the token is being distributed. There are two basic ways most crypto tokens are generated. They are either pre-mined or released through a fair launch. A fair launch is when a cryptocurrency is mined, earned, owned, and governed by the entire community. There's no early access to the token or private allocations before making them public. Then, pre-mining is when a number of the crypto tokens are generated and distributed amongst exclusive addresses, usually project developers, other team members, and early investors, before going public. Most crypto projects these days come with pre-mined tokens, so you must not be wary of a project simply because some tokens were minted before it went live. However, check if there's any wallets that keep hoarding a significant percentage of the circulating token supply, since this means there's a huge risk of the whale dumping their holding and dropping the price of the token in an instant. On the other hand, if the project is distributing the tokens to as many participants as possible, you can assume the project is a legitimate one and genuinely cares about the further development. Secondly, the supply of the token. A primary component of a crypto's tokenomics is the supply of it. Remember, the law of supply and demand is immutable. When evaluating the potential value of a token, you must consider three key numbers. The circulating supply of a token is the number of tokens that have been issued so far and are currently in circulation. The total supply is the number of tokens that exist at present, excluding any that might have gotten burned. The max supply of a token is the maximum number of tokens that can ever be generated. For some tokens, there's no determined max supply. If you notice the circulating supply of a particular token has been regularly increased by the project's developers over time, you can assume that the value of the token will be going up in the future. On the other hand, if there's too many tokens being released at once or too frequently, the value of the token might go down. Next is market capitalization. The market capitalization of a token shows the entire amount of funds that have been invested in the crypto project so far. Along with the market cap, you can also check the fully diluted market cap of a project, which is the theoretical market cap if the max supply of tokens was already in circulation. This would give you a good idea of how you should value a token. The higher a token's market cap and lower its circulating supply, the more valuable it could be in the future. Lastly, the token model. Make sure you know if the token is inflationary or deflationary. An inflationary token, like fiat money, doesn't have a max supply and will continue to be produced as time goes on. A deflationary token model is simply the opposite, where there's a max supply the token is capped at, like Bitcoin's 21 million coins. Most proof-of-stake tokens like ETH are inflationary so as to reward the validators and delegators in the network. On a side note, it is interesting to note that some crypto tokens also have a dual token model, like Maker DAOs, MKR, and DAI, where one token is used for funding within the ecosystem and the other is a utility token. Most of the factors that make up a crypto's tokenomics can usually be found on websites like CoinMarketCap and CoinGecko, but checking the project's whitelist paper is always a good idea. So you may be wondering, why is tokenomics important when investing in cryptocurrency? Well, Seth Klarman says that in the short run, supply and demand alone determine market prices. If that is to be true and that it applies to crypto assets using blockchain technology as well as the stock market, then understanding the factors that will impact either supply or demand are of vital importance to both speculators and investors. Tokenomics is also helpful as guidance to understand how much an asset might be worth in the future. Humans tend to make emotional decisions and buy into projects because they think, oh, I like that. But spending some quality time learning about the tokenomics of a project may help you make better choices. When you're considering any type of investment, you should conduct your own research and know the ins and outs of your investment. Do you do research before investing? What are your deciding factors to choose whether to invest or not in a project? Let us know in the comments below. If you enjoyed the video, please be sure to hit that like and subscribe button so not to miss out on more.